There's a four-stage pattern that has destroyed trillions in wealth, bankrupted thousands of companies, and wiped out entire industries 3 times in the last 200 years. And right now, in 2025, artificial intelligence is following that exact same pattern. In 2024 alone, $200 billion was invested in AI infrastructure. NVIDIA's market cap hit $3 trillion. Every Fortune 500 company announced an AI strategy. Within 18 to 36 months, 70% of these investments will be worthless. This has happened 3 times before: railroads in the 1840s, electricity in the 1920s, and the internet in the 1990s. And here's what should terrify you. We're not at the beginning of the AI bubble. We're at stage 3 of 4, the Euphoria stage, right before the collapse. This is the story of how technology bubbles always play out, why investors always believe this time is different, and why the mathematical pattern says AI companies are about to experience the same 90% crash that destroyed railroads, electrical manufacturers, and dot-coms. And it's happening faster than anyone wants to admit. Before we go through the 3 historical bubbles, you need to understand what a tech bubble actually looks like. Not in textbooks, in practice. Every transformational technology follows the same 4 stages. Stage 1 is the breakthrough, the moment when the technology proves it works. Real innovation, real potential, real excitement from people who understand what it means. Stage 2 is infrastructure mania. Once the technology works, everyone rushes to build the infrastructure. Railroads need tracks. Electricity needs power plants. The internet needs fiber optic cables. AI needs data centers and chips. Money floods in. Hundreds of companies form. Stock prices soar. But here's the trap. Infrastructure gets built faster than demand can absorb it. Stage 3 is euphoria. This is when the general public gets involved. When grandmothers start buying tech stocks. When every company adds the buzzword to their name. When valuations completely disconnect from reality. Profits don't matter. Cash flow doesn't matter. The story is everything. This changes everything forever. Stage 4 is collapse. Suddenly reality hits. The infrastructure is overbuilt. Most companies have no path to profitability. Investors realize they've been funding losses, not innovation. The stock prices that went up 10x in 2 years drop 90% in 6 months. Fortunes evaporate. Companies go bankrupt by the hundreds. The technology survives. It was always real, but 95% of the companies and 90% of the investment capital are destroyed. This pattern has played out 3 times in modern history. Same stages, same psychology, same mathematical result. Let me show you. In 1825, the Stockton and Darlington Railway opened in Britain, the first public railway using steam locomotives. It worked. It was revolutionary. Suddenly, you could move goods and people faster than ever before in human history. This was the breakthrough. Stage 1. By 1840, investors realized railways would transform everything: commerce, travel, communication, warfare. Parliament approved railway construction everywhere. In 1844 alone, 248 railway bills were submitted to Parliament. Everyone wanted to build tracks. Between 1844 and 1846, railway company stocks went parabolic. Share prices doubled, tripled, quadrupled. New companies formed every week. Hudson's railway companies saw their stock rise 800%. The Railway King was hailed as a visionary genius. Capital poured in. £60 million invested in 1844. £132 million in 1845. £200 million in 1846. That's equivalent to £200 billion today, in an economy a fraction of modern size. As a percentage of GDP, it was the largest investment boom in British history. By 1846, railway mania consumed Britain. Ordinary people mortgaged homes to buy railway shares. Clerks, shopkeepers, farmers, everyone was investing. Newspapers published nothing but railway company advertisements. The stock exchange was mobbed daily. Companies were valued at multiples of the entire track they'd ever built. Most had no completed railways. Many had no trains. Some had no actual plans beyond a name and a stock listing. It didn't matter. The story was enough. Railways will change the world forever. True statement, but terrible investment thesis. In 1847, reality arrived. Most railway companies weren't profitable. They'd spent fortunes building tracks, but couldn't generate revenue to cover costs. Competition drove down prices. Many routes had three competing railways when one would barely be viable. The stock prices collapsed. Companies that had traded at £100 fell to £5. George Hudson, the railway king, was exposed as a fraud. He'd been paying dividends from new investment, not profits. Classic Ponzi scheme. He fled the country. By 1850, over 400 railway companies had gone bankrupt. Investors lost £500 million, roughly 40% of Britain's annual GDP. The middle class was devastated. Thousands of families were ruined. And here's what people don't understand. The railways themselves were transformational. By 1900, Britain had an incredible rail network that powered industrial dominance. The technology was real. The boom was justified. But 95% of the companies went bust. 90% of the invested capital was destroyed. The survivors, a handful of well-managed companies, eventually became profitable. But it took 30 years. Britain built railways that changed the world and destroyed an entire generation of investors doing it. Let's jump forward 80 years to America in the 1920s. Electricity was the new transformational technology. By 1920, only 35% of American homes had electricity. By 1930, over 70%. Electric lights, electric appliances, electric factories. It was genuinely revolutionary. Thomas Edison's South Pearl Street Station opened in 1882. Electric power plants could generate electricity and distribute it through wires. It worked. It was reliable. And by 1920, it was clear electricity would replace gas lighting and steam power everywhere. Between 1920 and 1929, hundreds of electric utility companies formed to build power plants and distribution networks. Investors understood, whoever controls electricity controls the future economy. The money flooded in. Electric utility stocks became the hottest investment on Wall Street. Companies formed holding companies, which formed more holding companies. Abasco, Electric Bond and Share Company, owned stakes in 200 utilities. Insul Utility Investments controlled companies in 32 states. The structure was Byzantine, designed to hide debt and inflate valuations. Stock prices exploded. Commonwealth Edison went from $200 to $450 per share between 1927 and 1929. Consolidated Gas went from $80 to $360. Utility stocks as a sector rose 300% in 3 years. By 1929, utility stocks were 20% of the entire stock market value. Every investor owned them. Every portfolio included them. They were considered safe, stable, guaranteed returns. Everyone will always need electricity. True statement. Terrible valuation. Samuel Insull became the face of the boom. He controlled utilities serving 8 million customers. His companies had $500 million in stock value on $80 million in actual assets. The valuation was based on future growth that required constantly building new infrastructure faster than demand appeared. The public bought in completely. Ordinary Americans invested life savings in utility stocks. Widows and orphans stocks, they were called. Safe as houses. October 1929. The stock market crashed. Utility stocks fell with everything else. But then something worse happened. As the Depression hit, electricity demand didn't grow as projected. All that infrastructure built for future customers, power plants, transmission lines, distribution networks, sat underutilized. The holding company structures collapsed. When the bottom-tier utility couldn't pay dividends, the holding company above it failed. That triggered the next holding company to fail. The entire pyramid imploded. By 1932, utility stocks had lost 90% of their value. Commonwealth Edison fell from $450 to $50. Consolidated Gas fell from $360 to $20. Samuel Insull's empire went bankrupt. He fled to Europe to avoid prosecution. His companies, once worth $500 million, were worth $5 million. Tens of thousands of investors were wiped out. Retirement savings gone. Widows and orphans destroyed. The safe investment of the decade became the worst-performing sector of the Depression. And here's what people don't understand. Electricity was revolutionary. By 1950, America was fully electrified and dominated the global economy because of it. The technology was real. The transformation happened. But 90% of the electric utility companies failed. The infrastructure got built, eventually, by the survivors. But the investors who funded the boom lost everything. America got electricity and destroyed a generation of investors building it. Let's jump forward 70 years to the 1990s. The Internet. In 1995, there were 16 million Internet users. By 2000, 400 million. E-commerce, communication, information access, genuinely transformational. The World Wide Web launched in 1991. Netscape Navigator made it accessible in 1994. Amazon and eBay proved you could build businesses online. By 1995, everyone understood the Internet changes everything. Between 1995 and 2000, hundreds of billions poured into Internet infrastructure. Telecom companies laid fiber optic cables across continents, under oceans, through cities. More fiber was laid between 1998 and 2001 than in the entire previous century. Tech companies formed at an explosive rate. In 1999 alone, 457 Internet companies went public. Pets.com, Webvan, eToys, Cosmo, hundreds more. They all had the same pitch. We're the future of industry. Zero profits. Often zero revenue. Just a website and a story. Stock prices went vertical. Amazon went from $1.50 to $113 per share in 2 years. Yahoo went from $13 to $118. Cisco went from $5 to $80. And these were the real companies. The garbage companies, Pets.com, which sold dog food online at a loss, went from $11 to $14 billion in market cap in 6 months. 1999 to early 2000 was pure euphoria. Cab drivers gave stock tips. Day traders quit their jobs. Any company that added com to their name saw their stock double. Valuations were absurd. Broadcast.com, a barely functional streaming service, sold to Yahoo for $5.7 billion. It had $22 million in revenue and was losing money. The public piled in. Mutual funds, pension funds, retail investors. The Internet is the future was the justification for every valuation. Didn't matter that most companies had no path to profitability. Didn't matter that they were burning $10 million per month on Super Bowl ads and free delivery. The story was everything. The Nasdaq hit 5,048 in March 2000. Tech stocks were 35% of the entire S&P 500. Pets.com spent $27 million on advertising, 3 times their revenue, and was considered normal behavior. March 2000. The bubble popped. No single trigger, just reality. Investors suddenly asked, wait, how do these companies make money? The answer was, they don't. They never planned to. They were built to go public and cash out, not to build sustainable businesses. The Nasdaq fell from 5,048 to 1,114 in 30 months. A 78% collapse. But individual stocks were worse. Pets.com went bankrupt in 9 months. Stock went from $11 to $0. Webvan burned through $800 million and shut down. eToys collapsed. Cosmo collapsed. Hundreds of companies that had raised billions went to zero. Amazon fell from $113 to $6. Yahoo from $118 to $8. Cisco from $80 to $11. The survivors lost 90 to 95% of their value. The failures lost 100%. By 2002, $5 trillion in market value had evaporated. Pension funds decimated. Retirement accounts destroyed. Millions of individual investors wiped out. And here's what people don't understand. The Internet was revolutionary. Amazon, Google, Facebook, these companies eventually became the most valuable on Earth. The technology was real. The transformation happened. But 95% of .com companies went bankrupt. 90% of the investment capital was destroyed. The survivors took 10 to 15 years to recover their stock prices. We got the Internet and destroyed trillions in wealth building it. And here's what should keep you awake at night. Artificial intelligence is following the exact same pattern. Stage by stage, let me show you. ChatGPT launches. GPT-4 demonstrates genuine intelligence. LLMs can write, reason, code. Suddenly AI goes from research curiosity to practical tool. The breakthrough is real. AI works. The technology is transformational. 2023 to 2024, the infrastructure boom explodes. Every tech company announces AI initiatives. Microsoft invests $13 billion in OpenAI. Google reorganizes around AI. Meta spends $40 billion on AI infrastructure in 2024 alone. NVIDIA becomes the AI infrastructure play. Their GPUs power AI training. Stock goes from $150 in 2022 to $140 in late 2024, briefly hitting over $900 in 2024. Market cap hits $3 trillion. Jensen Huang is hailed as a visionary genius. Data centers are being built everywhere. Energy companies are reactivating power plants specifically to power AI training. In 2024, $200 billion was invested in AI infrastructure globally. That's more than the entire dot-com boom's peak year, adjusted for inflation. We're here, right now, 2025. Every company has an AI strategy. Every startup pitches AI. Every Fortune 500 earnings call mentions AI. Companies with AI in their description trade at 3x the valuation of identical companies without it. The public is getting involved. Retail investors are buying AI stocks. NVIDIA is in every portfolio. AI ETFs are the hottest products. AI changes everything forever. True statement. Catastrophic investment thesis at these valuations. Look at the behavior. Companies spending $50 billion on AI infrastructure with no clear ROI timeline. Startups raising $100 million at billion-dollar valuations with 10 employees and no revenue. Microsoft paying $650 million per year to OpenAI, which loses money on every customer. The math doesn't work. But nobody cares. The story is enough. We haven't hit collapse yet. But the pattern says we're 18 to 36 months away. Here's why. The infrastructure is being overbuilt right now. There are over 50 companies building foundational AI models. The market can't support 50. Maybe 3 to 5 will survive. NVIDIA's revenue depends on everyone buying chips for infrastructure that can't all be profitable. When AI companies start failing, when the infrastructure boom slows, NVIDIA's growth story collapses. And with it, the stock. Most AI companies have no path to profitability. They're losing money on every transaction. They're subsidized by venture capital hoping to go public or get acquired. That works until it doesn't. Pets.com had the same model. The public companies are valued for AI growth that may not materialize. Microsoft is valued assuming AI drives massive margin expansion. If AI becomes commoditized, and it will, those margins compress. The valuation collapses. Since 2023, we've accelerated every stage. ChatGPT went from research project to 100 million users in 2 months. NVIDIA went from $300 billion to $3 trillion in 18 months. AI infrastructure investment went from $50 billion to $200 billion in 1 year. We're not walking through the bubble stages anymore. We're sprinting through them. The dot-com bubble took 5 years from Netscape IPO to NASDAQ collapse. The electrical bubble took 9 years from boom to bust. Railway mania took 3 years. AI is moving faster than all of them. The infrastructure boom started in early 2023. We're in Euphoria by 2025. The pattern says collapse hits 2026 to 2027. 3 times it happened before. Railroads in the 1840s. Electricity in the 1920s. The internet in the 1990s. 3 transformational technologies. 3 infrastructure booms. 3 Euphoria phases. 3 90% collapses that destroyed trillions and bankrupted thousands of companies. The pattern says AI is next. Maybe we're different. Maybe this time the infrastructure won't be overbuilt. Maybe this time valuations are justified. Maybe this time 95% of companies won't fail. But the railways didn't avoid it. Electricity didn't avoid it. The internet didn't avoid it. The technology was real every time. The transformation happened every time. And investors lost everything every time. The math says we're at stage 3. The pattern says stage 4 is coming. And history, which has watched this exact sequence destroy wealth 3 times before, says AI investors are about to learn the lesson the hard way.